Welcome out to the second week of the BluSky Trading Lab here. This is Coach Matt. We're going to have a lot of fun here today as we talk a little bit about secondary pattern recognition. And first and foremost, guys, who here is first time to this lab? Who's first time? Yeah, I agree with that on the undervalue education, 100%. First timers? Okay. Now, for those of you that are first time here, hopefully first time, long time, coming soon. But in this lab, guys, we're going to be working on technique. We're going to be working on our skill set. We're going to be working on the understanding of all of these concepts from a technical analysis perspective. And so if you have any questions, go ahead and make them. You have comments, make them. I will tell you this, when I'm teaching, and it doesn't matter where I'm teaching, I'm going to tell you very simply, I only have 3 rules. Number 1, have fun. Trading's fun. Learning how to trade is fun. Digging ditches is not. We're learning how to trade. That's very fun. Number 2, no negativity. I don't tolerate it. I don't tolerate it around me. I don't tolerate it around my communities. I don't tolerate it for people who are sitting down in this seat trying to do the right thing for them and theirs. And so we're all going to be positive. It doesn't mean there's not things we have to overcome. But I just believe that in the positive mindset, no doubt about that, and do not allow negativity. And then the last, guys, just participate, have some fun. Learning how to trade is an enjoyable experience. Making money is even more enjoyable. And so with that said, guys, we are going to do a giveaway here today. I'll do it probably towards either the middle or the end of the program as we get in. We'll spend about probably around 45 minutes here today, I would say as well. Now, just a way of review, we did our first session last week, and we focused on three concepts last week we focused on. Number 1 was trend analysis, understanding the direction of trends and understanding the specific patterns that happen within a trend. And if you'll remember last week when we talked about the length of trends, we talked about the Elliott wave Fibonacci, we talked about directions, we talked about a lot of things when it comes to just from a trending perspective. And then we got into the types of patterns that dominate all degrees of trends, whether you're looking at it from a short-term perspective or a long-term perspective, doesn't really matter. It's a price action is price action. And so if you'll recall last week, we talked about 1 being the breakout. That's where you're looking to really kind of be aggressive, is on that breakout. And if you miss the breakout, this is something I want you guys to start thinking about here a little bit. If you miss your trigger in the market, and you know you miss your trigger in the market. And we all, if you've been a trader for a month, you know what I mean. How many of you have missed a trigger in the market before? I missed one today. Beautiful trigger. I missed it today. You're going to miss triggers, guys. It's going to happen. Let me hear it. If you haven't missed a trigger, you haven't been trading. Like, that's how it is. All right. So if you miss a trigger, should you chase the price action? Is that who we should be as traders? Should we chase? No. Guys, there's always going to be development of patterns all the time. Do not chase price action. If you chase price action, you're going to be taught very valuable lessons in carrying some bags and carrying some wicks here. And so your timing's got to be really, really good here as a day trader, swing trader as well. I do them both. And so pattern number 1, on the break, we want to be aggressive there. We want to be, we're tracking the breakout channel. When we break, we giddy up and, like I like to say, go, 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 but we never chase. Because chasing has a tendency to lead to conclusions that you don't want to be a part of, meaning you're buying when the pros and the people that weren't chasing are dumping it back to you after they had a very successful trade. And so in pattern number 1, we're aggressive, we're looking to buy, we're buying that breakout. It gets overextended. That's pattern number 2, overextended. When it gets overextended, we want to tap on the brakes. And specifically, we go into what I call pattern recognition, because there's a variety of different patterns that can occur here. And so, for example, I'm going to throw it out to the team here. Everybody give me the name of a pattern that you would like to see in an overextended condition. something that alleviates the overextension and give you a better trigger. A little bit of a double top. Yeah. Double top breakouts look good, especially if support increases. Double top, double bottoms, a little bit of a different story. But you know that, Andrew. Double top, absolutely. A bull flag, 100%. Little short-term momentum-based pattern. You're not going to get a lot of gaps there, Hope, especially on the intraday side of the equation. And you definitely don't want to be trading a gap in an overextended condition. That can be very sensitive and very volatile. Head and shoulders, if you're looking for a reversal, 100%, absolutely. Pattern number 2, guys, you can see reversals in pattern number 2. Now, initially, though, you're not thinking reversal in pattern number 2, correct? Like initially you're thinking bullish. And the reason is the trend's bullish. We don't want to trade against the trend. We want to initially look at through pattern recognition through the bullish lens. And if the data changes, that's when we switch to the bearish side of the equation. I will talk about that here in a little bit of time, because there is some commonality in reversal analysis versus continuation, but there's also some substantial differences as well. What Code had, awesome. What I would call is a retracement, right? According to Elliott wave, a corrective retracement could occur here, no doubt about that. And so you don't, when you get overextended in pattern number 2, you don't immediately call for the pullback. You get into pattern recognition. You be very open to the concept of different patterns here. You don't ever want to force your willpower on a market that does not know you exist. Read the price, follow the price. And so pattern number 2, we tap on the brakes, we get into pattern mode, and then when we see the pattern and it breaks the pattern, it's that point where we really want to giddy up and rock and roll in that environment. Now, pattern number 3 is typically the pullback. And so in the 1, 2, 3 pattern, the 1 is the breakout. As that breakout catches momentum and gets overextended, that's pattern number 2. We tap on the brakes. Pattern number 3 is the retracement. All right. That's what we covered last week, is really kind of looking at okay, here are the trends. Here are the time frames of trends. Here's how day traders look at the trending analysis. And now what are the patterns that dominate within most structures of trends? Now, when you're talking about the bearish side of the equation, guys, everything's just flip it upside down. Bears are just, instead of a breaking of resistance for a bull trigger, now we're talking about a breaking of support for a bear trigger. And once again, if you miss the breakdown, specifically the breakdown, if you miss the breakdown, don't chase, wait for it to get overextended, look for that secondary pattern. I want everybody to write that down. That's going to be very important. You're going to hear it from me a lot. Secondary pattern. What a secondary pattern means is the pattern that happens after the first move. And so if you see that first move, i.e. the breakdown, that next pattern is going to be a secondary pattern within the existing trend. Does that make sense, everybody? Jaja, yeah. Let me get some more typing in there. Yes. Awesome. Okay. So basically, in a nutshell, that's what we covered last week, was trend analysis, the 1, 2, 3 pattern within a multiple time frame structure. Before we get into the types of patterns that develop at those key levels in an overextension situation, I want to talk a little bit about momentum in trend. And well, there was actually a couple secondary triggers on secondary patterns, a couple high bases pretty quickly in the first hour and a half after that initial momentum. We'll take a look at that, no doubt. But I also want to kind of go back a couple of days ago and relive the cash open from the futures open, or the cash open on Tuesday, because I felt like there were some pretty good secondary patterns there as well. But before we get into case studies and looking at the data and talking secondary patterns, I want to talk about momentum, because momentum is really going to tell you what you should be looking for. are you in a secondary scenario where you're overextended? What is the trend momentum telling you? Because if you see increasing momentum going into a overextension, you're going to be looking for bullish continuation patterns. You're going to be looking for bullish momentum patterns. You're going to be looking for short-term high bases, short-term bull flags, real short-term though. You're not looking for anything too long-term creating. We're talking about a 30-minute time frame for pattern development type situations. And so when you're looking at a momentum condition in the market, you're not going to counter trade momentum, guys. Only if you like getting punched in the face by Mike Tyson back in 1988 do you want to counter trade momentum conditions. That's not going to work out for you long term. It might work out for you one time. It might work out for you 4 out of 10 times, but you do that 1,000 times, probability is going to catch you. There's no doubt about that. But that's a condition where you have a bullish trend with bullish momentum. And so let's define bullish momentum. Now, momentum can be seen through the lens of either the retracement or the breakout. And what I mean by that, guys, is let's just kind of go to Thinkorswim real quick, and we'll just kind of look at the virtual trader so I can get a clean chart here, do a little bit of drawing. Give me 1 second here, guys. Let me get my epic pen up. Once I do, we'll be ready to rock and roll here. All right. It's, there we go. Okay. Now, let's pull this back very quickly and talk about momentum. Now, momentum in a trend can be seen through the lens of two things. Number one is how far a breakout carries. How much momentum did the market have on a breakout? The second thing is to assess the waves of Elliott wave. And so a concept in the market, and this happens on any time frame, ladies and gentlemen. Let's say we have your standard higher high, higher low type scenario. And then in the next move, you go all the way up to that, and you do that type of number. We can obviously all see that that leg is longer than this leg. Can we all agree with that? That the third leg here is longer than the first wave. And if the third wave is longer than the first wave, what does that mean for the fifth wave from a probability perspective? It means it has a higher probability of having a fifth wave, is what it means. And so when you have trend momentum, the probability of another leg is elevated. Whereas if you see the exact same situation, but wave one is big, followed by wave three being a little bit smaller, the probability will start shifting. And so from a probability perspective, momentum in trend is a high probability scenario to see that pattern continue. Whereas when you see a shift in momentum in trend and we start to see slowing momentum, the probabilities start shifting to not getting a leg. Now, by the way, it doesn't mean we don't get back up to resistance. That's not what it means. It means we don't see that wave go up. Does everybody understand the difference in what I'm talking about here on the momentum side? The probability certainly suggests we're going to go back up to the top, but it doesn't say we're going to break the top. Whereas if you have proper trend momentum, that probability is increased for that leg to continue to go up. And so I just wanted to talk briefly about momentum because you can see it through the lens of your wave count. Wave one, wave three expands over wave one. You have a higher probability of getting that bullish wave five. Whereas wave one big, wave three smaller, you have a lesser probability of that wave five actually achieving a higher level of resistance. And so understanding that momentum is key because it helps us understand how aggressive we want to be. It helps us understand if we need to see confirmation or if we can just be aggressive from an order entry perspective. The second way you can look at trend momentum is from a resistance perspective in how far the breakout carries. So one is assessing the personality of the wave count. The other one is assessing the personality of the momentum conditions of breakouts, because retracements are not momentum-based patterns. They are a loss of momentum-based patterns, whereas breakouts are an elevated momentum-based pattern. And so as you can see here, you get that breakout and you get a quick $3 move. Well, then you get a breakout over here, you get an $8 move. That is momentum. And when you see that, you don't ask for, oh, I want to get this deeper pullback all the way down to say back to the breakout channel. It's just going to be very difficult when you get this type of trend momentum going up for any retracement to come back down to that same degree of level, which means you are looking for a momentum-based pattern at the top end of that trend. And so once again, when you look at the momentum conditions, momentum is really key because it tells me what type of patterns I need. If I have trend momentum, I'm looking for momentum-based patterns. If I have a loss of momentum, I'm going to be looking for a little bit of reversal analysis. Is everybody kind of understand kind of how momentum helps us understand what we need to look for next? Everything in trading is what we're doing right this very second, guys, but it's also getting ready for the future. You know, it's one of those things like traders just want to make decisions based on entry. Whereas when I'm thinking about this trade, I'm also thinking about the next trade. When I'm thinking about managing one trade, I'm thinking about what I need to see in terms of development for that next trade. And so that's momentum. Now, it happens on the bear side of the equation as well. Bearish momentum, you see it through the same lens. You either assess the wave count on the downside, resistance to support, or you assess the breakout channel from where it breaks down to how far it sells down. And so increasing trend momentum, giddy up and go on the downside, we're looking for momentum-based patterns. Whereas when we see decreasing momentum, this is where reversal analysis really starts to live, guys. You'd never want to get into a reversal conversation when you have a trend that looks like this at the top end of a trend. I see it all the time. I see it more times than I can count. And I see people complain when it doesn't work out a lot. People will get to the point where like, oh, that's too high. I'm going to short it on the way down. That's not what you do. You don't want to short a single pivot. You don't want to short a single pivot because you're shorting against the trend. You're shorting against the momentum. You're shorting against everybody in the market. You're saying, I know more than everybody else in the market. Whereas what you should do is say, okay, let's see if we can get that lower level of resistance on a pullback. Let's see if we get a double tap at resistance all the way back to support. And so in those overextended conditions, once again, we're reading the momentum of the condition, and that helps us understand what we need to be looking for next. Now, on the slowing momentum side, look at the breakout channels. It moves $4, moves $2, moves 50 cents. That is slowing down over time. Breakouts are getting less important over time. And when that breakout therefore turns into a fake out, all of a sudden you now told the bulls, we're not ready for prime time. Bulls leave center stage left, bears step in. And it's not based on the fact that it was the fake out. It's based on the fact that before the fake out, it was slowing momentum. The story of momentum can help you understand what you need to see. And so upward decreasing momentum is a telltale sign for reversal analysis. Increasing momentum is a telltale sign for continuation of momentum analysis. And so, for example, let's just look at it from a momentum condition. And let's go into the market from 2 days ago. Now, 2 days ago on Tuesday, okay, we're in the platform you're looking at right here is the Thinkorswim platform. How many of you are not familiar with Thinkorswim? I know a lot of people trade with Ninja and TradingView and BluSky. I got a positive opinion of both of those, by the way. Both TradingView and Ninja are fantastic. No thinking or swimming, RQ? That was funny, actually. That got me. I've been a Thinkorswim guy for it. This is true. This is true, Jaja. I've been a Thinkorswim guy since 08. So I was with Thinkorswim before TD Ameritrade bought them. So when I was kind of part of that merger that got merged into TD Ameritrade, and then eventually they got merged into Charles Schwab. And basically, nobody likes TD Ameritrade or Charles Schwab, but they do like this software. There's no doubt about that. Now, it's not the best like day trading software. It is the best option software if you're ever trading options. But again, it's a well-rounded software. I just wanted to make sure you guys knew what you were looking at here. Now, in Thinkorswim, there's something. Yeah, I use it primarily for options, Codehead, but I also day trade with them as well. But in Thinkorswim, there's a system called the on-demand program. And what you can do with that is you can go back in time and simulate data to get a tremendous amount of experience utilizing live data in a simulated environment. And you can actively trade it. You can get the experience. And, back testing, especially if you're newer, I would strongly recommend finding a back testing software that you do feel comfortable with. There's a lot of them out there. Again, I'm not recommending Thinkorswim. I'm just saying this is the one I use. Now, if you look at the chart here, we're looking at the NASDAQ. We're going into the cash open. Okay. Now, question. Right here, are we technically overextended on this 5-minute chart going into the cash open from this pivot point right there? Are we technically overextended here? Yes or no? Yeah, Ninja's good too, Code. Like Ninja's probably even better from a coding perspective. Yeah, I would call it overextended. Okay, so we got a bullish trend. And also, this is only kind of first leg, so we really don't know momentum, correct? Because momentum is within trend. But can we kind of assume there's a little bit of momentum here going into that cash open? I mean, there was not a lot of red candles there, right? So we have a little bit of momentum. We have a bullish uptrend. What should I be thinking going into that cash open? Should I be thinking bull or bear? I'm definitely not thinking short. I'll tell you that right now. Okay. But I'm also not thinking anything until I get a pattern. Does that make sense, everybody? Like I'm thinking bull because the trend's bull. I'm thinking bull because the trend's bull with momentum. I'm thinking bullish, but not right now because we're overextended and I don't want to be the last to buy in a single move, which means I need to see a pattern. Does that make sense, everybody? I can't chase. I can't short. I need to see a pattern. And once I get my pattern, whether it's a 15-minute consolidation high base, like it doesn't have to take long, guys. If you're looking at a 5-minute chart, if you go back a couple of days ago, this was 5 candles in development. That's it. It was like about 30 minutes in development. And so it doesn't take long to alleviate overextended conditions when you're talking about a day trader. Now, as a swing trader, you got to wait a week, right? But as a day trader, you got to wait a half hour. You get to go watch a TV show, come back, and then you're ready to giddy up and go again. But that's what you're looking at. You get overextended, you wait on that secondary pattern. Now, we got our secondary pattern here, okay? We're going into the cash open right here. Now, I'll tell you right now, I'm going into any bank open, any cash open. How do you guys typically approach the ding ding? The doorbell's ringing, the market's open, cash is flying, trades are happening. How do you guys? Yeah, I wait. And I strongly recommend wait on direction. You want to wait on not only direction, but you want to wait on the volatility smoothing out on the open. And the reason being is you got a lot of orders coming in on the open, and you got a small hole coming into these data centers, and you got a lot of orders, and it can be a little bit sensitive. And especially if you trade like options, like my goodness, the market maker has a terrible time in the first like 5 minutes of the trading session, really narrowing the bid-ask spread on options because, again, lots of movement happening at the open. So you want to give it a little bit of time before the market really does pick a direction here. And so let's kind of let that play out here for a second. Now, downward decreasing momentum happens the exact same way. So here's my question for you. In a bullish trend with bullish momentum, what am I looking for? In a bullish trend with bullish momentum, what should we be looking for? Momentum-based patterns. Momentum-based patterns. Everybody write that. Momentum-based patterns. Don't call for the pullback. You might not get it, guys. It's not. It doesn't have to be a pullback. That thing can consolidate and give you the best picture ever. High base is just as good as a pullback. I can tell you right now. Oh, I love that hope. You're looking for a pattern and then the break of the pattern. 100%. That's exactly what you're looking for. You're looking for momentum-based patterns. Okay. Now, because with momentum, guys, a pullback is a loss of momentum. That's why. Does everybody understand that? When you have trend momentum and you call for a pullback, you're calling for that momentum to cease. You're asking to lose money. You're asking for the wrong thing there. Now, there might be some of our language here because a bull flag is a pullback and a bullish retracement is a pullback. But there is a difference between the depth of that retracement. I'll talk about that here in a second. There's a lot we need to cover from a technical analysis perspective, but we got a lot of time to do it. We don't have to do it in every single session here. All right, but does everybody kind of have an understanding of the trend momentum perspective? So when we have trend with momentum in a secondary situation, we ask for pattern development, a momentum-based pattern. Now, in a trend with slowing momentum, what are we going to look for? Anything. Pullback, reversal. We're just very open-minded, but a reversal certainly does start to creep into the thought process there. No doubt about that. All right. Now, let's talk a little bit about the types of patterns so that we can have a visual. So for example, when I say bull flag, when I say pennant, when I say triangle, when I say ascending triangle, when I say cup and handle, when I say the descending, the inverteds, all that jazz, does everybody have a crystal clear understanding of every pattern that I just listed? And I only listed a few of them, guys. And I'm trying to understand how much we need to work on patterns. So we're pretty good on patterns. By the way, if you're new and you're like, I don't know if I should say yes or no. Believe me, I'm an educator. I don't leave people behind. So I don't like, for people that have a deep understanding of pattern recognition in our second week doing this is going to be a review for them. I want to bring everybody up to the same level, right? I love a triangle, no doubt. Cup and handles, I'm down for. Love time consolidation, no doubt about that. Okay. Now, the patterns I'm talking about specifically, guys, are patterns that develop in the overextension scenario. Okay. So these patterns up here, because quite frankly, when we're talking about a breakout, I don't really care what it's breaking out of. I'm just looking at the breakout. But when you're talking about this second pattern up here, and you hear that phrase, I'm waiting on a secondary pattern. I need a secondary pattern. I'm looking for a secondary pattern. That's what I'm talking about. The patterns that develop at the overextension that tell us, one, we should be buying, or two, we should be selling. Because I know we all have had that question, right? Market's at the high point. Do we buy? Do we sell? Market's at the high point. Oh my goodness, are we going to see the continuation of momentum, or are we going to get whipsawed like we did yesterday? Right? We've all had those questions. That's what I'm talking about in terms of the development, because simply because you're overextended, you don't know. And so I want to talk about just in general what these patterns kind of look like. Okay. I was trained to identify pivots myself, Gloom. I don't use anybody else's form of technical analysis, Gloom. I use my own. I've long held the belief that is, if you can master the concept of price, you don't need anything else. And so I focus on price is what I focus on. And there's a lot of ways to view that, right? I'm not trying to say one's better than the other, not at all. I've been around the market long enough to realize there are really cool techniques that I don't personally use, that when I find them, I'm like, wow, that's really, really, really cool. I've even seen Steve in the last couple of days. I've seen Mike over the last couple of weeks describe things, and I'm like, oh yeah, that's how I see it from a candlestick perspective. And so I think everybody has a little bit of a unique way of navigating the market. There's commonality in all of that. There's some differences, but I would like to know them though, Gloom. And so I'm more than happy to talk about them. And I will do some research as well. Now, the types of patterns I want to talk about are the momentum-based continuation patterns, the structure of pure continuation patterns, and then what we would refer to as more of the reversal patterns. Okay. So camel pivot, seriously. Oh, I love you guys. All right. So when we look at a high base, low base, the first pattern that you really kind of anchor against in a momentum condition is you anchor against the bases. And the bases are high base, simple consolidation, low base, simple consolidation in a downtrend. And what simple consolidation, guys, is it doesn't have a defining characteristic of pivots. And what I mean by that is when you come back out to the market a little bit here, and you're looking at this little consolidation here, up, down, just consolidation. A pivot has to have a minimum standard of candles both in front of the pivot and behind the pivot to actually create a pivot. And can anybody tell me how many candles does it need, according to most technicians, I would say, to define a pivot? How many candles do you need in between pivots to actually have a pivot? You need 3. That is true. Great job, guys. Great job. You need 3. If you don't have 3, it's not a pivot. It's consolidation. It's a high base. It's just something else, right? And that's important because pivots define patterns. Pivots define the difference between a cup and handle pattern and an M, which stands for murder pattern. A pivot is the difference between a ascending triangle pattern and a cup and handle pattern. And so pivots are really important because they help us characterize the differences between all of these different patterns. And so when you don't see a pivot, it's consolidation. And that is what we call a high base. And what the high base does, guys, is it's actually a momentum-based pattern because you have momentum in trend, but people aren't profit taking. They're just sitting through it. Does that make sense, everybody? Nobody's dumping here. They're like, why would I dump? We got momentum. I'm not dumping. I want to get the bigger trade. I want to get the bigger trade. I don't want to cut off the trade. I don't want to stop out short. I want to keep that momentum going. Well, that's that high base. And then when you see that high base come to a proper conclusion and we break out, we're still waiting on the cash open there. But when you see that come to a proper conclusion and break out, that's when you're trying to make that trade. And so it's actually a really good pattern in terms of short-term consolidation. And that's what we got kind of going into the cash open yesterday on Tuesday, is that consolidation high base. Now, on the flip side, we got the low base. Low base has trend momentum, consolidation, and then it violates that support level. And so on the bull side, trend momentum, consolidation, we took a break, we're ready to run again. And so it's like we ran a mile, we took a break, had some water, and now we're ready to run again. That's what the high base is and the low base. Now, flag-based patterns are a part of the pullback family. And I structure this through what I call the depth of the retracement conversation. That's going to be a topic for next week. It's a very important one. We'll do that one next week. But flag-based patterns are a pullback, whereas there's no pullback in a high base. You have a short pullback in a flag. Now, typically speaking, the flag will come into some shorter duration moving average, some support level, but we're only talking really about 2-3 candles on the downside here, guys. We're not talking a lot of time in flags, because if you spend a lot of time in a flag, it's not a flag any longer. It's going to be something else. And so flag-based patterns are momentum-based patterns as well. Now, the other types of patterns you see in the market at the top end of the trend are more of the continuation family. And what I mean by that is these take a little bit more time. So high bases and flags take minimum standards of typically 2 to 5, 6, 7 candles, but you're not looking anything longer than that. And so if you're looking at a 1-minute chart, we're talking about less than 10 minutes in time duration. You're looking at a 5-minute chart, you're talking somewhere around 30, 40 minutes in time duration. But all that's doing is just consolidating. But again, it's more about the candles. And so typically speaking, 2 to 3 is kind of a flag, 3 to 5 is kind of a base, but anything that is less than, say, 7 or 8, I think you're fine with on the momentum-based patterns. Any candles more than that, you're talking something else. Something else is occurring out there. So once again, on the momentum-based patterns, you're talking 2 to 3 candles at a minimum, 7 to 8 candles at a maximum. Does that make sense, everybody? Okay. Now, on these types of patterns, ascending triangles and descending triangles, they don't really have a minimum candle in them because there are pivots here. And what I mean by that is you have constant reversal pivots. Look at that pivot right there. You get another pivot right there. But all the while, and this is extremely important, guys, support is increasing. Resistance can do whatever it wants, but as support constantly increases, it's putting a tremendous amount of pressure on that breakout. As support increases, the journey to the resistance level is tightening, which allows the market to break out with some burst. And a lot of times, because the triangle creates pressure, you can see some explosive breakouts through the continuation lens. Because once again, I want you to think about this like pressure. The bears are defending that resistance zone nonstop. They defend that resistance, but support is constantly increasing, which means if you think about this from a trench warfare World War I perspective, well, the British and the French and the Americans are getting closer to those German lines, and it's putting a lot of pressure on them. Well, eventually we're going to see somebody retreat there, and we see the bears retreat really aggressively on an ascending triangle break. Descending triangle, same type of concept, horizontal support, constant reduction in resistance, tells you that the bears constantly control the price action, and we're just waiting on the eventual bear breakdown in that situation. Now, a very close friend holding hands will say to the ascending triangle and descending triangle is the cup and handles. Cup and handles are very similar. The only difference is I do like the World War I trench warfare. I'm a history guy, Phibbs. I do like history. So not everybody gets that one, but I do like it. So thank you. The cup and handle is very similar to the ascending triangle in the sense that you have, especially right here, you got that elevated increase in support, shortening the journey going into the breakout. But you got the cup here. You see that lower level of the cup, a little double bottom action there. That increase in support, I can't tell you in the backdrop of continuation patterns how much we get from increases or decreases in support within the backdrop of that consolidation. Once we start to see elevated increases of support, the bulls have control of the price action and the bears are getting nervous. We're just waiting on the confirmation breakdown or breakout. Whereas on the inverted cup and handle, we got the cup, short porch resistance, meaning resistance lowers its threshold going into the breakdown. Once you see that right there, that is a really good sign going into that potential breakdown. Think about this from a trading psychology perspective. The bulls here, they're fighting for support. They can't even fight long enough to get into the next resistance level. That scares the bulls. It excites the bears. Where's all those bull stop losses? They're right under support. Once you break support, that can trigger a little bit of momentum there as well. So you got the ascending and descending triangles on the continuation side. You got the cup and handles on the continuation side as well. You also got pennants and triangles and symmetrical triangles and all that jazz. I'm not the biggest fan of the symmetrical triangle, quite frankly. I really like ascending triangles. I really like descending. I really like cup and handles. I really like inverteds. I really like bases. I really like flats. And I mean, I love a retracement. I just don't like symmetrical triangles. And the reason being, it's very simple, and I'm not judging people who do. This is just more of a me thing, right? This is just more of a me thing. I don't like the explosive volatility that can happen to them, number one. But number two, one thing I love about an ascending triangle is the horizontal nature of resistance. It is such a clean trigger to enter on the trade, and the stop loss underneath the pivot point on the support level is really simple to understand as well. So the trigger mechanism is, and the management side of it is really, really simple. And a lot of times when you're breaking out of some degree of time consolidation, you have what I call open air, which means there's not a lot over here to stop price trajectory. And so I do like the cleanliness of the triangles and the cup and handles. But when it comes to a symmetrical or a pendant, I don't have that feel, because you got the resistance is constantly coming down, support is constantly coming up. It is putting a tremendous amount of pressure to break one way or the other. And a lot of times it can be explosive. And so for traders that love explosive volatility, they're going to love triangles. Even the ascending triangles, the descending triangles, the pendants, or the symmetrical triangles. But people that love the consistency of open air, they're not going to love triangles. And I've taught enough people in my life, guys, and when I mean enough, you'll be surprised at the number. I've been doing this for a very, very, very long time. To me, you either like them or you don't. And I'm just going to ask you guys, who here loves trading a symmetrical triangle? Sarky, you did at one point, but it's not kind of your thing here. BluSky. Yeah, I don't love them. Gloomhawk, you just don't like patterns at all? A little bit just momentum-based stuff? Making an assumption. I don't know what your trading style is, Gloom. Blank chart, let it rock, love it. I've long held the belief that people that don't trade patterns just can't see them. I don't understand why somebody wouldn't trade a pattern that has a probability edge to it. Pattern recognition tells you exactly what the rest of the market is thinking. Yeah, that's okay. That's different. Yeah, you're right. I mean, scalping is going to be different there, Gloom. Like, no doubt. I'm talking more of like a standard day trade here instead of just like a momentum-based scalp. And so scalping, like pattern recognition and the detail of patience in waiting on pattern recognition, it's gonna be a little bit different. Well, yeah, you'll scalp. If you're not hitting a high percentage of your trades, I don't know what you're doing, Gloom. Like, of course, you should be hitting a high percentage of the trades you're scalping. You're not holding against loss. You should 100%. If you're not, there's an issue there. But the thing about day trading is you do not need to hit 91.35% of your trades to be the best traders in the history of mankind. And that's the thing. Everybody's going to be unique. Everybody's going to be unique. My way is not the end all be all of the high. Like, that's not who I am, guys. I believe that there are a billion different ways to trade, and there are many different ways to be successful in the financial world. What I hope to do is, through these lessons, is simply enhance your skill set. Wherever your skill set is, that is my only goal, is to enhance your skill set. I have no other goal outside of that. Insult to his dad, BluSky. Oh, BluSky, you're gonna kill me. That's so funny. Oh yeah, the volatility lately for day traders have been out of this world good. The volatility for other time frames of traders, they hate it. Like how much day traders love this environment, guys. Other traders hate it. Like this is a beautiful day traders environment recently. I do a lot of swing trading. I don't do any swing trading right now. None, zero, none. I haven't done a swing trade in over a month. Because why would you? I can't project outside of a day trade. Why would you swing trade if all you can project is a day trade? I like the conversation. I'm going to get back to this though. So I just wanted to explain that very quickly. So let's take it to the whiteboard here. So I'm going to draw some things and you guys tell me what you're looking for. Okay. So we got a trend, higher high, higher low. That should represent momentum. What am I looking for at that level? At this level, what am I looking for? Yeah, well, what types of patterns though? Well, I'm always looking for patterns. I'm a pattern trader. Momentum based, right? Momentum based. I want to see, I got momentum in trends. I want to see momentum patterns. I want to see a bull flag. I want to see a high base. Those two specifically, that's what I want to see. I want to see the shallow pullback, which is the flag, or I want to see the short-term consolidation dial in that resistance level before we eventually break it and run again. So momentum and trend, I want to see that momentum-based pattern. Now, regardless of momentum and trend, if you see something along the lines of that, that is a cup and handle. That is an ascending triangle. Both of them lead to the conclusion of the breakout. And so regardless of what you're seeing, guys, I always want to be clear on this. Pattern recognition is only viable once the pattern is broken. It's the pattern that tells us where we should be looking for it to break. But we want to see the pattern get broke. We want to see that bull flag get confirmed. We want to see that high base go above resistance. We want to see that bullish retracement confirm with a confirmation candle, right? Yeah. Okay. Now let's kind of go back into think or swim here, and let's look at yesterday very quickly. Now, yesterday, let's see, where are you doing? Let's go 6:30. We're on the open. All right. Okay. So right here, we're moving up. We get a little bit overextended here. What do we wait on? We're waiting on the cash open. You're seeing it right here, guys. You're waiting on that cash open. All that's doing, I could care less what's happening here, honestly. It's the cash open. I don't care. We're reliving 2 days ago's cash open, guys. Remember, on the cash open, do I want to be too opinionated on the cash open? Or am I just letting volatility come out of the cash open and for the market to pick a direction? We're just waiting on the market to pick a direction. Now, the previous direction was bullish. I'm waiting on bull here. Now, the question is, where do you trigger here? Okay. Now, for me, when I'm looking at a situation like this, guys, what I will do is I'll just go to the active trader and I'll just go put my orders in the active trader. And so I'll just come here and I'll just kind of show you how I do it. Put my standard order in there and I'll just kind of do 10 points just to kind of show you. I know you guys aren't think or swim people, so we don't need to spend too much time here. But so basically what I do here is if I'm looking right above that wick, you see these two wicks right there on the cash open, I'm looking right above those wicks there. Here's the base, here's that resistance level. I'm already above it. I've already tested above it, so I don't need to see much more. Here's resistance right there. I'm already above it right here. I need to get above that wick. That's me. I got to get some degree of confirmation. Now, I'm not thinking too aggressively here. I'm just kind of waiting on that volatility to play out a little bit. Now, as the market works into that level, that's where I want to trigger. I don't want to trigger underneath this resistance at 1815. I don't want to trigger underneath that resistance. I don't want to trigger underneath this candle. I don't want to trigger underneath that wick. I want to trigger with momentum. The reason I had momentum in trend, I'm looking for some momentum follow through. I want to trigger aggressively on that. Does that make sense, everybody? Okay. Now, as the market kind of works out here, and it's going to take a little bit of time, but as the market works out, let me kind of go forward a little bit of time here. And actually, let's go to, let's just pull up another chart here. Okay, so NASDAQ 5 minutes. Ooh, does anybody know what Google reported? I have not looked at Google's earnings report yet. Sorry, I have to look. Google's it's on one of my watch lists. Whatever they said something pretty decent. About 7 points. Going to be breaking out. It's going to test that 50-period moving average on a gap out channel. Must have beat. We'll see what they said on guidance. Interesting. They had a beat. I mean, it's been interesting this earnings season. This earnings season has been unique in the sense that we haven't seen typical earnings moves here. But the last 3 trading sessions, this week specifically, we're starting to see some earnings moves. And today specifically, if you're in the stock market, guys, 3 themes happening on earnings. Number one is we're seeing commodities like FCX, Newmont Mining, gold miners, relative outperformance on earnings analysis. We're seeing AI names, technology names start to do relative outperformance on earnings. We saw that out of Lam Research and ServiceNow here today. You saw Taiwan Semiconductor with an amazing beat last week. And so what you don't have, though, is consumer-facing names. In the stock market right now, consumer-facing names, airlines, retail stocks, anything that has anything directly tied to the consumer, they're not doing very good on earnings. And so I saw a couple of questions on that. Thought I'd just add some of my earnings analysis to that equation, as we do have a fairly sizable earnings report here today coming out of Google. Coming back to that just a few days ago here on that Tuesday, guys. Here's what that price action, and I'm looking at a 30-minute chart. I'll come back down into a 5. But here's where that Tuesday price action was. It was right here on this cash open right here. Came down, went back up, confirmed its close above that handle right there, and then it was off to the races. Now, if you'll come fast forward a little bit of time here, guys, do you see how it goes up, but then it flatlines right here? You see that consolidated resistance level? Okay, now do you see how it just consolidates there for about 4 or 5 candles? And then it breaks out right here? Do you guys see that? Let me kind of come in here. Do you see this little consolidation high base? Yeah, that's that second trigger right there. That trigger right here getting above that level, that would have been the second trade. And so the first trade's on this candle here or that candle, and then the second one's right there. And so when you're looking at this initial surge, if you miss that, guys, don't chase it. Just don't chase it. Wait for the consolidation. Now, do you see this pink line here, guys? How many of you use moving averages? Who here uses moving averages at all? Yeah, I do. I used to not be a moving average guy. I used to make fun of moving averages, quite frankly, because I was like, "Oh, you need the training wheels on, huh?" Okay. I used to be that guy. I'm not that guy anymore. The reason, the data changed me. Algorithms use moving averages. The vast majority of algorithms that are programmed in the market use moving averages. They're very simple, by the way, very simple. There's some complicated algorithms, very complicated algorithms out there, but there's a lot of simple ones out there too. And a lot of them use moving averages. And I find moving averages to be fairly consistent these days to help us understand trend bias, kind of momentum conditions, crossovers. I found a deep respect. I'm kind of like that. Gloom, I did too. That's kind of how I found it too, brother. I mean, my brother Mark is a big moving average guy. I am not, but he spent a lot of time studying historical data on moving averages. And after I looked at his studies and kind of tried to chop him up and tell him he was wrong, I had to admit that he was right. And so I kind of started incorporating them into my own analysis. And my favorite moving average, if you only had to pick one moving average, what would it be? If you only had to pick one, if you only got one, mine's the 9 EMA. Me and Gloom, 100%. Mine's the 9 EMA as well. I have often called the 9 EMA the number one momentum indicator in the market. The number one momentum indicator in the market is the 9 EMA. Now, if you use the 8 or the 10, it's going to be very similar, guys. Very, very similar. Like I've got in arguments that lasted for literally days about the 8 EMA being so much more valuable than the 9 EMA. And then some dude's like, no, it's the 10 EMA. And I'm like, I really don't care. It's giving you a very similar read. It's giving you a very similar read. Me, I think it's the 9. Well, I'm a 9 rider. That's just what I am. And do you see how as the market starts to consolidate, do you see how that 9 EMA catches up to it and then it makes its decision? I see this all the time in the market and not necessarily on like the 5-minute time frame as much as say like 1 hour time frames, 4 hour time frames, daily time frames, those types of time frames. But the 9 EMA can be utilized on almost any time frame, quite frankly. And so I would strongly advise to incorporate some degree of 9 EMA into your analysis because it is a really, really important indicator, guys. I mean, take a look at, for example, we'll take it outside of the intraday timeframes here. Look at for example, here, 9 EMA test, got into the 9 EMA, 9 EMA. 9 EMA is going to work as a resistance level so much. I'm not kidding, guys. I have seen the 9 EMA and not gold, but crude oil. I've seen crude oil ride the 9 for 40 days before. 40 days and 40 nights, it rode the 9. I actually think it was like 43 or something along those lines. It was absolutely ridiculous. But even on gold here, guys, look at the last 2 days. Big downward movement of price. What stops it on a dime? The 9 EMA. Well, what's gold doing? Bullish trend, bullish momentum, pull back to the 9 EMA. And so the 9 EMA is kind of that first zone of any pullback or any base that we're kind of using as an anchor to some degree. For example, look at the current price on the NASDAQ. Remember that pullback we saw earlier today? Guess what it caught on? The 9 EMA on the 30-minute chart. You come out to the hourly chart. Look at all the momentum on the cash open. What happened today? 9 EMA crossed over the 20-period moving average. Now, is there other ways to describe that outside the 9 EMA? Of course there is. But the 9 EMA is always a commonality there. Always. Regardless of how anybody else wants to describe it, I always see the 9 EMA as part of that overall puzzle. And even on the intraday side of the equation, ladies and gentlemen, when we go back to this Tuesday case study that we were looking at, when we got that beautiful little breakout and got that nice little trend. Well, let's make sure we're looking at the right data. There we go. Well, what happened right here when we got that high base? 9 EMA catches up. Once it does, it rides it, and then it breaks. You also got to snap back right back down to the 9 right there on that snapback on the 1 minute time frame. And so, yeah, I definitely would incorporate the 9 EMA into that analysis because a lot of times when we do get overextended, we get overextended because of immediate momentum in the market. And oftentimes people are like, well, how long is it going to consolidate? And like I said, what is the average time in consolidation in a high base? It can go anywhere between really kind of 3 and 8 days. In a flag, you're really talking 2-3 days, but it can go 3-4 days, right? But when you're talking about the amount of time it takes, oftentimes I'm actually thinking, well, how long is it going to take for the 9 EMA to catch up to the price? Because a lot of times the price is either going to come down in a flag to the 9 EMA, or it's going to consolidate and the 9 EMA will catch up, like we saw right here. Catch up, we see the breakout. Catch up, see the breakout. Yeah, like it's a really, really, really good indicator. So once again, when we coming back to the original conversation, and guys, have you enjoyed this conversation today? I have a ton. And I'm going to tell you right now, I love the participation. This is awesome, guys. Awesome. So coming back to the original conversation, we were talking about what to do in overextended conditions, what type of patterns to look for in overextended conditions. The momentum helps us understand the types of patterns we need to look for. But at the end of the day, at any point of overextension, I'm always getting into pattern recognition mode. And that's through the lens of, first, the momentum-based patterns, second, the continuation-based patterns, and then ultimately, the reversal patterns. If one, the momentum patterns don't play out, meaning they never trigger, they just kind of design. Number two, they turn into continuations that never design. And then ultimately, three, if a momentum-based high base does not work out, it will turn into a continuation pattern that, if it doesn't confirm, eventually becomes a reversal pattern. And in those reversal patterns, that's where we're looking to be aggressive on the short side of the equation as it violates support. And next week, that is exactly what we're going to talk about, is reversal analysis 101 in a conversation I like to call the art of the reversal.